So in this video, I'm going to talk about the difference between a private investor like yourself versus hedge funds and institutions. A lot of people believe that you have no chance against a hedge fund. You cannot outperform a hedge fund. You cannot outperform the index, the market. And these are common, over-exaggerated financial truths. And if people actually realise they have huge advantages over hedge funds and institutions, if they turn around their entire strategy and their structure, they would realise they're in a far greater position than they realise, and that is yourself. So where does it come from? I mean, I personally remember my dad wanted to try Forex trading, which is high risk, volatile type trading, try to read candles and charts, similar to day trading, well, exactly as day trading. And he always used to say, oh, you know what, there's no point in this anymore because you just can't beat the institutions. And I tell you what, he was right, because as far as day trading and that type of high frequency trading, you'll never beat institutions at that, because they have distinct advantages in that area that you'll just never have. They've got an Ethernet cable plugged into the New York Stock Exchange. They have AI tools that can make microsecond, split-second decisions that humans just cannot make. So, I tell you what, in my own hobbies, I'm a massive MMA fan, a boxing fan. And one of the most common strategies in mixed martial arts is you would never fight your opponent where they're strongest. You'd always fight them where they're weakest. And the same rule applies to investing. Because if you try and take on hedge funds at their strength, which is like, high frequency trading and day trading, you will lose that battle. You want to take the fight to somewhere where you hold all the advantages. And the biggest advantage you have is freedom, agility, time, no pressure, and most of all, patience. A lot of people feel that the hedge funds have access to some secret information. They have access to data that you'll just never have access to. That is true in some regards, but it's not true for the thing that matters the most, and that's liquidity. So let's go through it. So people assume hedge funds are apex predators, but actual private investors like you hold far more advantages than you realise. Number one, you have no career risk. Okay, so if your stock portfolio doesn't perform, do you lose your job? No. Okay, it's your own portfolio, it's your investment. You don't fire yourself, right? So you have no career risk. Fund managers get fired after a few bad quarters. They're under tremendous pressure to perform. You are not. You just care about making money. No redemption pressure. Okay, so you don't have a requirement to sell, right? So if there's a crisis, hedge funds need to sell to meet their client redemptions during crises. So they're forced to sell, whereas you are not. Okay. Remember, when they are selling, they're realizing gains. They're paying tax. That's something I'll go into in a little minute. You don't have any benchmark handcuffs. So funds must beat the S&P 500 or they will risk losing clients' assets under management. You don't have that pressure. Okay, they have that pressure. Hedge funds have shorter time horizons. This is a big one. This is a really big one. They are looking at quarterly performances, or even over the maximum, maybe over 1 year to 3 years. You have a compounding advantage. You ever notice a lot of the time when a company reports earnings and it surges after earnings, like Nvidia has a great earnings potential and it surges. Most of that is institutional buying power. It's not retail investors. Retail investors aren't pushing massive stocks like that up, 5 to 10%. That is institution buying. Notice that they are reacting to earnings. Earnings that have already happened. They're reacting to that and they're buying into that. The advantage you have is you've got the freedom of thinking where you can invest in companies before their earnings come out. So you have a longer time horizon. That is one of the biggest advantages that you have over hedge funds. So you're not reacting to earnings and then investing. You're not chasing the green days. You're investing in these companies before their earnings come out, looking at a longer time horizon, and you can hold the stock and you have the compounding advantage. Liquidity lens. Now you have access to the same data. Okay, so you can focus on liquidity. When you follow this channel, you're following what my videos are talking about. You can track the money supply, the reverse repurchases. You'll understand the yield curve and how that impacts the future. You're going to understand credit spreads. That's the difference between US Treasury bonds and corporate bonds. You're going to understand all of this on this channel. So when you understand liquidity, you understand this information, this is a game changer. You're no longer being gatekept. You now have access to the same information that they have. It's public information. See, information's everywhere, but interpreting it is the challenge. But on this channel, I'm going to interpret liquidity signals. So you now have that advantage on this channel, and you then have the rest of the freedom, the time, the no pressure, and the patience. You've got no regulatory or mandate constraints, okay? You don't need to balance your portfolio in a certain way that meets regulations. It's your portfolio, you only answer to yourself. This is another huge advantage. You've got no size problem. So funds can easily, hedge funds cannot easily get into a position without moving the market. This goes for them when they enter a position and when they sell a position. See, they almost are fighting themselves when they sell and when they buy. If they're moving huge amounts of capital, they actually send the stock up massive amounts or down massive amounts. Have you ever noticed when a stock, a blue chip stock, dips like 3% on a day? It normally happens over a consecutive amount of days. That's institutions slowly selling their positions little by little, because they can't just dump all the stock in the one go, because they're dumping on themselves because they have so much allocation on that position. Whereas you can just buy into a position and you don't have that problem, okay? Because you're not moving billions of capital. You don't have any groupthink or narrative pressure, so you can think independently. So you're not pushed by narratives. Whereas institutions, they have to chase narratives. They're reactive investing. What's the current narrative? Is it AI? Is it Nvidia? They're chasing narratives, whereas you can think independently for yourself. You can say, I can see institutions are chasing after Nvidia, but wait a minute, aren't the big hyperscalers, the blue chip tech giants, the ones creating those earnings for Nvidia? So I'm going to invest in Google, I'm going to invest in Microsoft. Well, all the corporations, institutions are chasing Nvidia. See, you can do that type of independent thought, whereas institutions are under so much pressure, they're chasing those earnings reports and they're buying and they're selling because they're under all this pressure. No fee drag, okay, so you keep 100% of your compound growth. There's none of the fees that hedge funds have to pay. Buy, borrow, die. So hedge funds must sell to show performance. So you have a superior tax management advantage. This is the most powerful, underappreciated advantage you have. You do not need to sell your positions. Okay, so think about this. I'll give you an example. Nobody can outperform the index. Okay, this is the most exaggerated financial truth in the financial industry. So answer this question for me, right? If nobody can outperform the index, what would happen if someone just invested 100% of their portfolio in Microsoft? Well, Microsoft's still a blue chip giant. They would have outperformed the index. Someone just held Google. 100% stock portfolio is Google. They've outperformed the index if they just held their stocks in blue chip giants. Think about that. Okay, so this myth comes from Warren Buffett was speaking to institutions and hedge funds when he said it's hard for them to outperform the market. So even professionals can't outperform the market. What makes you think you can? That's the way people have framed this myth. Because he was speaking to hedge funds who have regulations and mandates and performance, people just thought, well, if a big hedge fund can't outperform the market, I certainly can't. When it's the actual wrong way of looking at it, because you have advantages that they don't have. The translation of no one can outperform the index. 99% of large, fee-charging, highly regulated funds cannot beat the index because they are forced to diversify. They cannot take large bets. It is structurally impossible for a hedge fund to just YOLO into a blue chip company like Microsoft, because if it drops 20%, there's a huge scandal. Clients will panic, clients will want to redeem their assets, the fund manager will get fired immediately. They just can't do it. They cannot just do that. They can't just YOLO into a stock, right? You can though, if you want. This is what I'm saying. You're in a position hedge funds are not in. You could certainly invest your full portfolio if you wanted into a blue chip giant, tech giant. And you could, if you can handle the 10% drops, the 20% drops, and you have that conviction, you can, it's absolutely possible for a private investor to potentially outperform the index with the wise investment decisions. Because the fact is, most of the people that do outperform is entirely the behavioural and psychology of the investor themselves. This has been proven many times. Why is it that deceased investors outperformed the market? They outperformed, their portfolios outperformed because they didn't touch it. See, sometimes the best action is no action when it's investing, which goes against people's instincts because they feel like they want to be in control, they want to take action, they want to feel like they've done something. So, as wild as it might seem, like someone that just held Microsoft, Google and Apple and Meta and blue chip solid stocks, they would have outperformed the market. So there you go, you have advantages. The stock market is not rigged against the retail investor. This is what retail investors say because they don't understand how the market works. And I've said in all of my videos, I cannot tell you what the stock market is going to do tomorrow, but what we can do is we can track liquidity. If you understand liquidity and you understand incentives, you can make your investment decisions the exact same way a bank does. I'll give you an example. Well, I'm on the topic, right? The yield curve. The 2-year treasury and the 10-year treasury. If the 2-year treasury is dropping more than the 10-year, that signals to banks that future Fed rates are going to happen. They make a calculated decision to begin lending more money to customers, mortgages, long-term debt. They are betting on the fact that rates are going to cut in the future and they'll make big profits in the future. They're also buying into a 2-year treasury yield because they anticipate that that yield is going to be worth more when the Fed cuts rates. So they're making a calculated investment decision based on liquidity. And it's a chain reaction. The yield curve is dictated by the bond market, right? Who is the bond market? That's money market funds. That's commercial banks. That's the Federal Reserve. They are the people that own the bonds, the treasuries. So they're the actual ones that have the bonds, and yet the bond market is dictated by the people that hold the bonds, which is the commercial banks. So the commercial banks are buying into the 2-year treasuries. 2-year treasuries yields go down, the value of their treasuries will go up when the rates get cut. It's a big chain reaction. The money supply goes up because banks are lending to consumers. Consumers are buying mortgages or they're expanding their businesses. Asset prices go up. One man's spending is another man's income. Ray Dalio teaches you this. Liquidity is predictable. The stock market itself is not, but it's not random. It's not random. People think a big market crash just happens. Sometimes, there's tariff announcements, there's COVID, but the liquidity is already there, the stock market will recover. If you understand this and you have this conviction, you will not be intimidated by the stock market. That is what I'm trying to teach on this channel. You understand the liquidity, you understand your advantages, you can make generational wealth. That's not even just an exaggeration, that's just facts, that's just truth. Because you invest in the S&P 500 and you keep that, even just held that for 40 years, 50 years, 60 years, passed it on to your children into a trust, no capital gains tax because you never sold it. That goes inherited onto your children. Your children have generational wealth. That is what we teach on this channel. Okay, we track liquidity the same way commercial banks do, the same way money market funds do, the same way institutions do. Okay, the data is there. It's understanding it which will put you into the top 1% of investors. You want to be in the top 1% of investors, understand the macroeconomics by following this channel and using your advantages. Anyway, I got into a bit of a rant at the end of this video. The point being, the stock market is not rigged against you. You have advantages that you can utilise. You just need to build conviction and compound your knowledge on this topic, because the more you understand, the more conviction you have, and Bloomberg news will not shake you. CNBC's news will not shake you, right? The media won't drive your investment decisions, because you are going to start acting the same way the commercial banks do and the bond market do. The most intelligent capital in the world is the bond market. This is they are emotionless. They just go on the data, and that's what you're going to start doing as well. Focus on the data, and that will help you drive more safer and intelligent investment decisions. Anyway, if you like the video, leave a comment, like, and subscribe to the channel. And I promise you, watch more of these videos. You're putting yourself in the top 1% of investors, and you will not have any regrets.